Welcome to Money News. I'm Kathleen Walter. Joining us now is renowned economist Robert Wiedemer. He's the co-author of the book Aftershock: Protect Yourself from the Next Global Financial Meltdown. And he's also a regular contributor to the Financial Intelligence Report. And Bob, thanks so much for talking to us today.
Well, thanks for inviting me on, Kathleen.
Well, there's been a lot of speculation and fear about just when the Federal Reserve will begin tapering its quantitative easing or QE policies. When do you think the Fed will start to pull back the punch bowl, as they say on Wall Street, and what will happen to the economy when it finally does?
Well, I think what's more important is what happens to the stock market. The fact that it is creating so much fear tells you what's really driving the stock market. It's not the economy. It's not the fundamentals. It's clearly printed money, and that should worry anybody who's investing in this. That's not only an economy that's slowing down. Well, I'm not sure slowing down, but it's slow in the U.S., but it's slowing down around the world. As I emphasized so many times, the stock market, the S&P 500, really does depend on those overseas earnings as a big part of their overall earnings picture. So when the rest of the world's slowing down, ultimately so's our S&P 500 corporations. As to the timing, well, I think they're going to talk about it for a while. Eric Rosenberg just came on and said that maybe in a few months they'll have to see what the labor data is. So I don't think anybody can say for sure, because they're gonna look at the data and they're going to interpret it, of course. But I think just the talking about it and some of this should make people aware that it's not only that QE, that this stuff can end for a while, but also how dependent this market is on QE. That should be bothersome, and we're seeing more and more people writing about that QE ultimately isn't really the source of real financial growth, either in the stock market or the economy.
You recently wrote that many people on Wall Street are trying to fool themselves. You wrote in a recent Money News blog that, quote, they don't want to look at basic economic data showing very little growth. They don't want to see a global economy that is in or near a recession in most countries. And in the few having growth, they don't want to see the massive slowdown. When will this reality hit the United States?
Well, it's kind of like, when does the reality that internet companies aren't going to make a lot of money or any money hit? It can still be 1998 or 1999, although we've been in this for a while. And it's not just that macroeconomic data that's bad. It's the micro data on companies that's not very good either. We're seeing, greatly reduced earnings per share growth in industries like telecom. We're seeing earnings per share growth declining significantly, 10% or more, while we're seeing the stocks being up 15% or more. Revenues are declining for the S&P 500, yet stocks are up. So it's not just the economic data. It's definitely that economic data is affecting the companies. And, it's hard to say exactly when, but, clearly it can only go on for so long when you're getting increasingly stressed from reality, just as the internet showed.
And what about the world economy? We're getting mixed signals here as well, with the Eurozone economy shrinking for a record sixth consecutive quarter in the first 3 months of the year. France is in recession. What's your outlook here?
Well, I'm not sure how mixed the signals are. I think you're referring to Japan, which, because their own money printing, is showing some growth again. How long that'll last, we'll see, and how much of that's just taken from other countries like Korea or the U.S. and their exports, we're going to have to take a look. But overall, I wouldn't say it's a mixed picture out there at all. Everybody is slowing down. Canada, Australia, Brazil, Peru, Denmark, Russia just cut the government just cut their growth rate from 2% to 1%. So I think you're seeing a pretty broad overall slowdown. Australian PMI is below 40, and 50 is the point between which you see growth or contraction. And China is slowing down. So I'm not sure how much growth we're really seeing in China. Again, their purchasing manager index is also negative, and that country clearly depends on manufacturing. So I think we're seeing an overall slowdown, and maybe it's only mixed just because Japan is printing a bunch of money for a while, and that could work for a little while. But overall, I think they're just probably stealing exports from other countries.
Jim Rogers recently told Money News that he doesn't think the euro will survive as we know it. What do you think?
Well, the euro may or may not survive. We've seen how much people, are stuck by it, or how much they dislike it. But I've always said I think it's a little less of a euro problem and more of a debt problem. And I think we try to want to avoid that a little bit, is that the debt is the real issue. Even if you did convert out of the euro, let's say to drachmas in Greece or pesetas in Spain, you've still got a debt problem. That's just sort of another way of defaulting on the debt. And defaulting on the debt is going to be a huge problem for French and German banks, the British banks, even U.S. banks. So although the euro may not survive, I think much more important is that even if it switched out of the euro, you've still got a huge debt problem. And that's the fundamental problem facing Europe. And, not easily solved even by switching out of the euro, certainly.
You touched on Japan earlier. Japan just okayed a $906 billion budget. How much do we need to worry about the Japanese yen's weakening past 100 per dollar, the weakest level in over 4.5 years? And is the global currency war inevitable?
Well, certainly Japan is kicking off a bit of a currency war. In reality, currency wars are started by printing money. And, we've been printing money for a while, and so has Europe. But could the yen go down further? Yes, I think it could. It might stabilize around here for a while, but fundamentally, Japan is doing exactly what it takes to push that down even further. Yeah, that'll help their exports a bit, but it's going to hurt their imports too. I mean, the goods that people import in Japan, energy and so forth, are also going up in price a lot. So we're also going to have to see what effect that has on the economy. But back to the currency wars, yeah, I think we're going to see some of that. And again, that's overall not necessarily positive for the world economy. I think it's just going to be, everybody kind of fighting for a shrinking pie at this point.
Bob, let's run through some investments real quickly and give us your quick take, beginning with gold.
Mm-hmm. Well, as we all know, gold's been trading horribly lately. It's certainly down, significantly from where it was. It peaked in 2011. I mean, it was actually up for the year last year. The real problem has been more in the last, 3 or 4 or 5 months of this year, and we've seen it, become a problem. Yeah, it seems to have gotten a little bit of a support level here. Although it's bouncing back on 1,400. I still think gold is good long term, but this frankly, it does bother me short term. I can't say we won't see more instability. It's interesting though. I noticed J.P. Morgan came out with the call this year that gold will hit 1,600. Now that's down from 1,800, which they had thought before. I still like it long term, but yeah, I'm a bit nervous about this short term. And even though it is finding a bit of a floor here, I still have a little nervousness on it short term. Long term, I'm still very good on it.
And what about bonds, government bonds, corporate bonds?
Boy, well, down yesterday, up today, kind of thing. And literally, we'll have to see. We're hitting a point now where the 10, 20-year bonds are tending to get some support. I'm not sure that's, the support level's been here for about the last 12 months, where they are now. Let's see if that has an effect. It's a bit of a flip of the coin on bonds. I'll be honest. I'm gonna have to see on that one. I just flip of the coin right now.
And what about emerging markets, Bob?
Well, emerging markets, stocks can always do better than the economy. Japan shows that. We're showing that. So the emerging markets, stock markets might go in. Certainly, they tend to follow in tune with the developed markets. When we go up, they tend to go up more. We go down, they tend to go down more. But overall, with that slowing economy, that's got to worry me. It worries me too in Europe. It worries me, even though German stock market just hit a recent high. It's got to worry you more long term on emerging markets. That doesn't mean that they're not going to, continue to ride a little bit with these markets if they go up. But again, with the QE issues and so forth, we may be seeing an end to the current little bubble in stock markets as well. But fundamentally, what I'd worry about in those emerging markets is, the economic growth is slowing down a lot.
Bob, last question for you. What is your best advice for investors right now? Where should they put their money?
Well, it's a time when both bond markets and stock markets are a bit unstable. And sometimes there's a role for cash in here. And I think a little heavier cash makes sense right now. I even wrote an article in the Financial Intelligence Report on that very recently. So that's one thing. And I think we'll just have to see. I want to see how this correction, if it turns out to be a correction, plays out. Longer term, I certainly do like a bit of gold. I certainly do like, well, we'll have to see how the stock market correction goes. I want to play that one by ear. And, we'll have to see. I think cash is going to be a little bit better right now, to be honest.
All right. Robert Wiedemer, thanks for joining us today.
Yeah, thank you.
And thank you for watching Money News.